Namaskar dosto. Today we are going to discuss an important subject in our episode 16. What is a multi-bagger? The 7 characteristics revealed. The 7 characteristics every 10 next Indian stock shares revealed. Section 1, the upper circuit, most dramatic opening in the series. On May 31st, 26, yesterday, Aditya Infotech hit 10% upper circuit. Trading was temporarily halted because the stock rose so fast that exchange had to pause it. Why? Because the company had just reported extraordinary Q4 results. Revenue up by 45.5%, EBITDA up by 162%, and profit margin expanded from 10% to 18% in one single year. The stock is now 167% in just 1 year. That means if you had invested 1 lakh exactly 1 year ago, you would have had rupees 2.67 lakhs today. That kind of stock, one that returns multiples of your investment, is called a multi-bagger. The term was coined by the legendary investor Peter Lynch in 1989, and here is the most important question in all of investing. Could you have spotted this company before 167% move, before the upper circuit, and before the news headlines? The answer with right framework is yes. In the next 15 minutes, I give you the framework, the 7 characteristics that every multi-bagger shares before the big move happens. Then in the next section, we'll see the Peter Lynch Foundation, the foundation connected to everything learned in episode 11 to 15. In 1989, American fund manager Peter Lynch wrote a book called One Up Wall Street. He managed the Margin Magellan fund in Fidelity and turns it into the best performing mutual fund in the world. His core insight was deceptively simple. The best stocks to buy are the companies you can understand, companies, those products you use, whose services you recognize, whose brands you see in your daily life. In India, Eicher Motors made a Royal Enfield motorcycle that every Indian on the road could see it. Bajaj Finance was the EMI company every Indian used when buying electronics. Asian Paints was the every Indian home. These were the ordinary Indian companies doing extraordinary things, hiding the plain sight, and every one of them showed the same 7 characteristics before they became the multi-bagger. The 7 characteristics we have actually been studying without naming them in episode 11 to 15. Today we connect each dot. In section 3 next, the 7 characteristics. Introduction, screenshot this, each characteristics as to reveal it. Every multi-bagger I had studied in 30 years of evaluating companies for the commercial banking decisions shares 7 characteristics before the big price move. Not all the companies have all the 7, but the greatest multi-baggers typically show 5 or more. Let me walk you through each one of them. Number 1, revenue growth 20% plus consistently, the growth engine. Characteristics 1, no company in the history has ever become a multi-bagger with a flat or a declining revenue. The top line must be growing, and not just for one good quarter but consistently. Aditya Infotech today, revenue up by 45.5% year on year basis. That is not the one character miracle. Check the 5-year revenue growth trend in screener.in P&L tab from episode 13. The genuine multi-bagger candidate shows revenue growing at 20% or more compounded every single year for at least 3 consecutive years in the episode 11 point number 1 and 7 point framework. Revenue growth was the very fast check, and without consistent top line growth, nothing else matters. Now the second point, expanding profit margins. Profit grows faster than the revenue. Characteristics 2. This is the most powerful characteristics all when revenue growth and margins expanded simultaneously. The bottom line grows dramatically faster than the top line. This is called the operating leverage. Look at what Aditya Infotech just reported today. Revenue up by 45%, but EBITDA up by 162%. Margin jumped from 10 to 18% in 1 year. When this happens, 2 things occur simultaneously. Earnings grow faster and the market awards the higher PE multiples to the improved quality business. The result is the explosive stock price move on. Screener.in P&L tab, watch the EBITDA margin now for the 5 years. Is it consistently expanding? That is your most powerful multi-bagger signal. Then the next one is strong ROE about 20%, the mathematical engine of compounding. Characteristic 3, from short 20 return on equity, every great Indian multibagger showed a ROE about 20% consistently for years before the market recognized it. ROE is the engine of compounding. When a company earns 25% on its equity every year and reinvests those earnings back to the business, the intrinsic value compounds at 25% per year. The stock price must eventually catch up with the intrinsic value. Infosys maintained ROE of about 25% for 15 consecutive years before becoming India's greatest wealth creator. Check ROE on the screener.in ratio tab. 5 years consistently about 20%. That is the benchmark. Number 4, low or declining debt. The balance sheet must support the growth. Characteristics 4, from short 21 to 27, debt to equity and interest coverage ratio. The greatest multibagger in India typically grow without excessive debt. A debt-free company growing at 20% keeps all the growth for the shareholders. The heavily indebted company gives a large portion of the future earnings to the bank as interest. Additionally, in the market correction of 2026 with Nifty 11% below ETH, debt-free companies survive and thrive while the leverage companies struggle. Check DE ratio below 0.5, ICR above 5 on screener.in. These two numbers together tell you whether the balance sheet is supporting the threatening the growth story. Next, the real cash flow. The profit must be confirmed by OCF. Characteristics 5, from short 22 to episode 14, operation cash flow. Every genuine multibagger generates real cash. OCF consistently above the net profit for the years. This eliminates accounting fiction entirely. A company cannot fake free cash flow for the 5 consecutive years. When OCF consistently exceeds PAT, you are looking at genuinely high quality earnings. And from episode 14, free cash flow equals OCF minus capex. A company with a growth free cash flow funds its growth, pays dividends, reduces debt, makes acquisitions without asking anyone for money. That financial self-sufficiency is the hallmark of every great Indian wealth creator. Next, promoter conviction. The founders must believe in the business. Characteristic 6, from short 23, promoter holding India's the greatest multibaggers were typically led by the founders with a significant and a growth stake in the own companies. Narayan Murthy at Infosys, Rajiv Bajaj at the Bajaj Auto, and the Godrej family at the Godrej Consumer Products. These promoters had enormous personal wealth directly tied to the company's performance. That alignment where the founder and the shareholders share the same destiny is one of the most powerful forces investing. When the promoters are steadily buying more shares, that is the insider signal saying, I believe in the company will be worth for more. Check the shareholder stamp on the screener.in. Promoters holding above 50% stable or rising, zero pledging. Then the next is reliable valuation. Buy quality before the market wake up. Characteristic 7, from short 24, P and PEG ratio, and from short 25, price to book ratio. Characteristics 1 through 6 identically. A quality business. Characteristic 7 determines whether you are paying the right price for the quality. The best time to buy the multibagger is when the PE is below the sector average and the PEG ratio is below 1.0. When the price to book is reasonable relatively to the ROE. Many Indians' greatest multibaggers were hiding the plain sight quality business at unrecognized valuations. The market eventually recognized what the fundamentals already showed. That recognition gap between what the business is worth and what the market is paying is where the multibagger returns are made. Be early, be right, be patient. Coming up, the multibagger scorecard applied to live example plus the 3 value traps that look like a multibagger but destroy your wealth. The most protective 4-minute in the episode. These 7 multibagger characteristics Characteristic number 1, revenue growth 20% plus. What to check in the screener.in? 5 year sales row growing 20% plus CAGR consistently. Then the next characteristic number 2, expanding EBITDA margin. What to check in the screener.in? EBITDA margin row rising every year for 3 years plus. Then the characteristic number 3, ROE above 20% for 5 years. What to check in the screener.in? ROE row 5 years historically consistently above 20%. Then the next characteristics number 4, low debt to equity ratio below 0.5. What to check in the screener.in? Debt to equity ratio plus ICR above 5. Check 5 years history. Then characteristic number 5, OCF above PAT, real cash. What to check in the screener.in? OCF row versus PAT. FCF is equal to OCF minus capex, growing cash flow tab. Then the next characteristic 6, promoters above 50% stable. What to check in the screener.in? Shareholding above 50%, no pledging, stable or rising. Then the next characteristic number 7, PEG ratio below 1%, reasonable price. What to check in the screener.in? Profit PE ratio, profit earning ratio divided by the earnings growth rate below 1.0 is equal to attractive always. Score 5 or more out of 7 is equal to multibagger candidate worth deep research. All 7 is equal to exceptional educational framework only, and this is not an investment advice. Then in the next section, 3 value traps that destroy your wealth. Critical warning, the most protective section. Deliver with a genuine concern. Now I must warn you about 3 situations that look exactly like a multi-bagger opportunities but are actually dangerous when destroyers. Trap 1, the penny stock lottery, a stock that is rupees 2 that could go to rupees 20 sounds like a 10 bagger, but most penny stocks have zero consistent revenue growth, no ROE, no OCF, no promoter conviction. They are promoter manipulation stories disguised as a multi-bagger. Apply the 7 characteristics, they fail and almost every count. Tab 2, the cyclical recovery story, a commodities or a steel company whose profits are recovering after a bad cycle. The PE looks cheap, margins look great, but this is a top of the cycle, not the beginning of the compounding journey. Revenue growth and margin expanding must come from structural improvement, not cyclical recovery. Trap 3, the high debt growth story, revenue growing at 30% but the funded entirely by the debt. The interest coverage ratio from chart 27 will reveal immediately the OCF from episode 14 is negative while PAT is growing. That is the final confirmation. It is a trap. Apply 7 characteristic, recognize new trap. Next is section 5. We're going to see how to check multibagger in screener.in within 30 minutes. I'll show you step by step. Go to any Google browser, type screener.in. This screen will get opened and then press this, click on the screens and again click on the create new screener. Here you have to write a query. Our first query shall be sales growth above 5 years. It should be greater than 20%. Then and next condition, return on equity. This should be greater than 20%. And the third condition, debt to equity ratio, it should be less than 0.5 always, less than 0.5. And finally, cash flow from operations last 1 year, last year it should be positive, that is it should be greater than 0. You have to write. Then if you run this query, you will get lot of companies here. What you have to do is In step 3, from the narrowed result list, look for the companies where EBITDA margin has been expanding for the last 3 consecutive years. Step 4, for each shortlisted company, calculate PEG ratio, take the PE ratio and divide by the earnings growth rate. Below 1.0, investigate seriously. Step 5, open each candidate and run the full 10-step analysis from the episode 15. Balance sheet check, profit and loss check, cash flow check, all 7 financial analysis ratio checks. Step 6, companies that score 5 or more out of 7 multibagger characteristics and show reasonable valuation. These are your candidates for the deep research. Always consult a SEBI registered advisor before any investment decision is made. Thank you. In the next section 6, your multi-bagger action plan. Most inspiring close in the series, genuine, excellent warmth. Your 5-step action plan for today. Step 1, open screener.in stock screener, filter for sales growth about 20% and ROE about 20% and debt to equity ratio below 0.5. Note how many Indian companies pass all these 3 simultaneously. I have already shown before here. Then in step 2, from those results, find out with the expanding EBITDA margin for 3 consecutive years. This is your most powerful filter. Step 3, click cash flow tab. Eliminate any company where OCF is not above PAT. Step 4, check promoter holding above 50% with zero pledging. Next, step 5, calculate PEG and PE ratio. PEG and PE ratio, PP divided by earning growth rate below 1. Run the full 10 steps analysis episode 15 and next Bajaj Finance, the next Eicher Motors, the next Infosys and they exist in the Indian today. Small companies doing extraordinary things hiding in the plain sight. Your job with everything you have learned in episode 11 through 15 is to find out them before the market does. The comment below with the company you screened in and how many of 7 characters it has passed. I reply to every comment every day and follow because the episode 7 is coming. Please subscribe, like, share with your family and friends and please support and give your feedback in the comments.